I need you to stop everything you are doing. Put down your phone, close your other tabs, and give me your absolute undivided attention. We need to talk about what's just happened in the financial markets because the world just shifted beneath our feet and almost nobody is talking about the true implications of it. For months, the mainstream financial media, CNBC, Bloomberg, the Wall Street Journal, have been spoon feeding us a very specific narrative. They told us that 2026 was going to be a quiet year. They told us that the Federal Reserve had engineered a soft landing. They told us that inflation was cooling, that the economy was resilient, and that we could all go back to sleep. They wanted you to believe that the system was stable, that the debt didn't matter, and that the adults in the room had everything under control. But in the first few trading days of this year, that narrative was shattered into a million pieces. Gold and silver did not just go up. They didn't just drift higher on a gentle breeze of optimism. They exploded. They moved with a vertical violence that we have not seen in decades. It was a jailbreak. It was the financial equivalent of a coiled spring, one that has been compressed for years by manipulation, by paper contracts, by false promises, finally snapping back with kinetic force. When an asset as large and as liquid as gold moves that fast, it is not a market fluctuation. It is a warning siren. It is the check engine light flashing red on the dashboard of the global economy. The market is screaming at us. It is telling us that the quiet year was a lie. It is telling us that the soft landing is a fairy tale. And most importantly, it is telling us that the smart money, the central banks, the sovereign wealth funds, the insiders, are rushing for the exits. They are getting out of paper and they are getting into metal. Why now? Why, after months of sideways chop, did the dam finally break? That is the question we are going to answer today. We are going to peel back the layers of this financial onion. We are going to look at the 5 specific kill switches that have been triggered in the global economy. We are going to talk about the debt spiral that has gone mathematical. We are going to talk about the silent collapse of the commercial real estate market. We are going to talk about the weaponization of the dollar and the rise of CBDCs. And most importantly, we are going to talk about you. Because right now, there is a window of opportunity open. A window where you can still protect yourself, where you can still move your wealth from the burning house of fiat currency into the fireproof vault of real assets. But that window is closing fast. The violence of this price move tells us that time is running out. By the end of this video, you will understand exactly why this rally is different. You will understand why this isn't just a trade, it's a paradigm shift. And you will know exactly what you need to do to ensure that when the dust settles, you are not one of the millions of Americans left holding a bag of worthless paper. Part 1. The illusion of price versus the reality of value. To understand this rally, you first have to unlearn everything you think you know about price. When you look at your phone and see the price of gold, what are you actually looking at? You are looking at the spot price. This is a number generated in London and New York by trading futures contracts. It is a digital number derived from people betting on the future price of gold, often without ever touching a single ounce of the metal. It is a casino. In this casino, banks can print unlimited paper gold. They can sell gold they don't have to people who don't want it delivered, just to influence the price. For years, this paper market has been the tail wagging the dog. It has dictated the price of gold. But something snapped this week. The physical market, the real world where miners dig rock and refiners melt bars, finally stood up and said, enough. We are seeing a phenomenon called decoupling. This is when the paper price and the physical price stop holding hands. While the spot price is shooting up, the real cost to get gold in your hand is skyrocketing even faster. We are seeing premiums explode. We are seeing out-of-stock signs at major mints. We are seeing delivery delays. Why is this happening? Because the physical market is honest. You cannot print a gold bar. You cannot short sell a physical coin that doesn't exist. When the demand for physical metal overwhelms the supply, the price must rise. There is no other option. The violence of this recent move suggests that a short squeeze is beginning. A short squeeze in gold is the nightmare scenario for the big banks. It happens when the entities that bet against gold, the ones who sold all that paper, suddenly realize there isn't enough physical metal to cover their bets. They panic. They rush to buy back their contracts. This creates a feedback loop. Buying begets more buying. Panic begets more panic. And the price goes vertical. We are seeing the early tremors of this earthquake. The big players know that the vaults are running low. They know that the West has been draining its gold supply to sell to the East for decades, and now the East isn't selling it back. The gold that goes to Shanghai or Mumbai stays there. It has gone from the Western financial system forever. So when you see the price spike, don't think, oh, gold is expensive. Think the dollar is collapsing. Gold is not going up. The dollar is going down. Gold is the constant. An ounce of gold today is the same as an ounce of gold in ancient Rome. It buys roughly the same amount of goods: a nice suit, a good meal, a bit of land. The variable is the dollar. The dollar is the melting ice cube. The spike in gold is simply the market repricing the dollar to reflect its true diminished value. Part 2. The first trigger, the mathematical doom loop. Let's dig into the 5 triggers that lit the fuse on this explosion. The first and most terrifying is the debt spiral. I know talking about the national debt sounds boring. We hear about it every election cycle. $35 trillion. It's just a number. It sounds like a sports score. But you need to understand that the nature of this debt has fundamentally changed. It has gone exponential. In physics, there is a concept called escape velocity. It's the speed you need to break free from gravity. In economics, there is a debt escape velocity, the point where the debt grows so fast that it can never, ever be paid back. We have passed that point. Here is the math that keeps Jerome Powell awake at night. The interest payments on the U.S. federal debt, just the interest, not paying down the principal, have now exceeded $1 trillion a year. That is more than we spend on the military. It is more than we spend on Medicare. It is the second largest line item in the budget, and it is growing every single day. Where does the government get the money to pay this interest? They don't have it. Tax receipts are falling. So they borrow it. They issue more treasuries to pay the interest on the old treasuries. Think about that for a second. Imagine you have a credit card. You max it out. Then you get a second credit card just to pay the minimum payment on the first one. Then a third one to pay the second one. That is the United States fiscal policy right now. It is a Ponzi scheme. The bond market, which is usually the smartest money in the room, has finally woken up to this reality. They realize that the U.S. government is insolvent. There is no mathematical path to a balanced budget. The only way out, the only way, is for the Federal Reserve to print money. To print trillions and trillions of dollars to monetize the debt. When they print that money, they dilute every single dollar in your savings account. They steal your purchasing power. The gold market sees this coming. Gold is reacting to the future flood of liquidity. The rally is the market front-running the inevitable return of QE infinity. The smart money knows that the Fed will have to choose between bankrupting the government or destroying the dollar. They will choose to destroy the dollar. They always do. Part 3. The second trigger, the Treasury revolt. This leads directly to the second trigger, the Treasury market breakdown. For 80 years, U.S. Treasury bonds were considered pristine collateral. They were the safest asset in the world. Risk-free return. Central banks around the world held them as reserves. Pension funds bought them. They were the foundation of the global financial pyramid. But in the last few months, we have seen something shocking. Failed auctions. When the Treasury tries to sell debt sometimes, nobody shows up, or the buyers demand a much higher yield interest rate to take the risk. We are seeing tail auctions, which is trader speak for nobody wants this garbage unless you pay us a lot more. Who is stopping the buying? China? Japan? Saudi Arabia? The biggest foreign holders of U.S. debt are selling. They are dumping treasuries. Why? Because they don't trust the U.S. anymore. They saw what we did to Russia. We froze their reserves. We weaponized the dollar. If you are China and you know you might be next, why would you hold your savings in U.S. debt? You wouldn't. You would sell it and buy gold. And that is exactly what they are doing. Central bank gold buying is at record highs. They are swapping paper promises from a bankrupt Uncle Sam for barbarous relic metal that has no counterparty risk. This is a vote of no confidence. It is a global mutiny against the dollar standard. And when the world stops buying your debt, you have a crisis. The US government needs to sell debt to survive. If foreigners won't buy it, the Fed has to buy it. And the Fed buys it with printed money. See the pattern? All roads lead to the printing press. All roads lead to inflation. All roads lead to gold. Part 4, the third trigger, the slow-motion crash of commercial real estate. While the government burns down the currency, the private sector is facing its own apocalypse. This is the third trigger. Commercial real estate, CRE. Walk through San Francisco, walk through Chicago, walk through New York. What do you see? Empty towers, ghost towns. The work-from-home revolution didn't just change our habits, it destroyed the economic model of the American city. Office vacancy rates are at record highs. But here is the kicker. The loans on these buildings were written 5 or 10 years ago when interest rates were near zero. Those loans are coming due. They need to be refinanced. But now interest rates are 5%, 6%, 7%. The owners of these buildings cannot afford the new rates. The buildings are half empty, generating half the rent, but the mortgage payment is doubling. It's a mathematical impossibility. So the owners are doing the only rational thing. They are mailing the keys back to the bank. Here, you take it. It's your problem now. And who holds these loans? It's not the big, too big to fail. Banks like JP Morgan, mostly. It is the regional banks, the small and medium-sized banks that form the backbone of the American economy. They are sitting on trillions of dollars of toxic waste loans. We saw a preview of this last year with Silicon Valley Bank, but that was just a tremor. The earthquake is coming. As these loans default, hundreds of banks will be technically insolvent. Their assets, the buildings, are worth less than their liabilities, the deposits. When this wave of defaults hits, the Federal Reserve will panic. They cannot let the banking system collapse. So what will they do? They will bail them out. They will create a new facility. They will print money to plug the holes in the bank balance sheets. The gold market knows this. Gold loves a banking crisis. Gold is the only asset that is not someone else's liability. If you have money in a bank, you are a creditor to that bank. If the bank fails, you are in line with everyone else. If you hold physical gold, you have no counterparty. You are your own bank. The rally in metals is a flight to safety from a banking system that is teetering on the edge of a cliff. Part 5. The fourth trigger. De-dollarization and the BRICS. Trigger number 4 is geopolitical. It is the end of the American empire's financial dominance. For decades, the U.S. enjoyed an exorbitant privilege. We could print dollars, send them abroad, and get real stuff. Oil, cars, electronics in return. The world accepted this because the dollar was the cleanest dirty shirt in the laundry basket. But the world is changing. The BRICS alliance, Brazil, Russia, India, China, South Africa, and now Iran, UAE, Egypt, Ethiopia, controls the majority of the world's commodities. They have the oil, they have the food, they have the manufacturing, and they are tired of the U.S. bully. They are building a parallel financial system. They are creating payment rails that bypass SWIFT, the U.S.-controlled payment network. They are settling trade in yuan, in rupees, in rubles. And they are discussing a new trade settlement currency backed by gold. Every time two countries trade without using the dollar, the demand for dollars drops. But the supply of dollars keeps growing. Basic economics, high supply, plus low demand, price collapse. Those dollars that are no longer needed abroad will come home. Trillions of dollars currently held overseas will flood back into the U.S. economy, chasing U.S. goods. This will trigger a wave of domestic inflation that will make the last few years look like a picnic. Gold is the antidote to this. Gold is the only international currency that cannot be sanctioned, frozen, or debased. The East knows this. That is why they are draining the COMEX. That is why the Shanghai Gold Exchange is booming. The center of gravity for gold pricing is shifting from west to east, and the East wants higher prices. Part 6. The fifth trigger. the rise of CBDCs, and the war on cash. The final trigger is perhaps the most personal and the most dystopian. It is the rise of central bank digital currencies, CBDCs. The government knows the fiat system is dying. They know the debt spiral is terminal. They need a new system. But they don't want to go back to a gold standard because that would limit their power. They can't print gold. So they want to go to a CBDC system. Programmable money. Imagine a world where your money is just a digital token on a Federal Reserve ledger. They can see every transaction, they can tax every transaction instantly, but it gets worse. They can program the money. They can say, you have already spent your carbon limit for the month. You cannot buy gas. They can say, you bought too much meat. Transaction declined. They can say, this money expires in 30 days. Spend it or lose it, to force economic stimulus. This is not science fiction. It is already being piloted in countries around the world. It is the ultimate control grid. People are waking up to this. They are realizing that money in the bank is not their money. It is the bank's money, and they just have permission to use it. The rush into gold and silver is a rush for privacy. It is a rush for autonomy. Physical metal is the only form of wealth that is digital proof. It cannot be hacked. It cannot be turned off. It leaves no digital footprint. It works when the power goes out. The explosive rally we are seeing is partly a freedom premium. People are willing to pay more to hold an asset that the government cannot control. As the talk of CBDCs gets louder, the demand for non-digital assets will go parabolic. Part 7, the psychology of the market, the boiling frog. So why aren't more people panicking? Why isn't this on the front page of every newspaper? It's because of the boiling frog syndrome. The changes have been incremental. First, inflation was 2%, then 4%, then 9%. Then they changed the calculation to make it look like 3%. People adjust. They get used to paying $8 for a carton of eggs. They get used to high rent. They normalize the dysfunction. But the market has a way of snapping people out of their trance. That is what this gold rally is. It is the water suddenly boiling over. The masses are still asleep. They are still chasing tech stocks. They are still buying the dip on the S&P 500, thinking that the Fed has their back. They are the dumb money. The smart money moves first. The insiders move first. The central banks move first. That is what we are seeing now. The vertical move in gold is the smart money positioning themselves before the crisis becomes obvious to everyone else. By the time your neighbor, your Uber driver, and your brother-in-law are talking about buying gold, the price will be $5,000 or $10,000 an ounce. The opportunity will be gone. The wealth transfer happens in the silence before the storm. We are in that silence right now, but the thunder is audible if you listen. Part 8. The strategy. Insurance, not speculation. So, what do? How do you navigate this landscape? First, you have to shift your mindset. Stop thinking about gold and silver as investments. An investment is something you buy to get rich. You buy a stock hoping it doubles. Gold is not an investment, it is insurance. You don't buy fire insurance on your house because you hope it burns down. You buy it because if it does burn down, you don't want to be destitute. You want to be able to rebuild. Gold is fire insurance on your financial life. The financial house, the US dollar, the banking system, the bond market, is filling with smoke. The alarms are blaring. The 5 triggers we discussed are the flames licking at the curtains. Would you wait until the roof is on fire to call the insurance company? No. You buy the policy when things are calm. Well, things are not calm anymore. The rally has started, but it is not too late. The price of gold adjusted for inflation is still nowhere near its true high. In 1980, gold hit $850. If you adjust that for the real inflation, not the fake government numbers, gold should be well over $3,000 or $4,000 today, just to match that high. We are still cheap, but you have to act correctly. Do not use leverage. Do not trade futures contracts. That is playing in their casino. They can change the margin requirements and wipe you out in a second. Buy physical. Buy things you can hold. If you can't hold it, you don't own it. If you buy a gold ETF, you are buying a claim on a claim. You are buying paper. In a real crisis, that paper might be settled in cash, not metal. You want the metal. Silver is the other half of this equation. Silver is arguably even more explosive than gold. Gold is money, but silver is money plus industry. We need silver for solar panels, for electric cars, for missiles, for electronics. The world is running out of silver. We have been in a supply deficit for years. Above-ground stockpiles are draining. When the rush to safety, gold, meets the industrial shortage, silver, the price of silver could do things that seem impossible today. It is the high-octane fuel of the precious metals market. But be warned, it is volatile. It will buck like a bronco. If gold is the safe savings account, silver is the speculative growth play. Part 9. The call to action. Don't be a victim. We are living through a reset. The old world, the world of cheap debt, stable dollars, and American hegemony, is dying. A new world is being born. It will be a world of hard assets, multipolar power, and digital control grids. You have a choice. You can cling to the old world. You can keep your savings in fiat currency. You can trust the politicians to fix the unfixable. You can hope that the debt doesn't matter. Or you can embrace the reality. You can accept that the math is undefeated. You can accept that history repeats itself. You can take responsibility for your own financial survival. The rally we saw this week was a gift. It was a signal flare. It was the market giving you one last chance to wake up before the real chaos begins. Don't let the media gaslight you. Don't let them tell you it's just a blip. It's not a blip. It's a trend. It's a structural shift in the global order. Go to your safe. Audit your assets. Are you exposed to the dollar? Are you exposed to the banks? Are you exposed to the bond market? If the answer is yes, you are sitting in the blast zone. Move your wealth to higher ground. Move it into assets that have stood the test of time for 5,000 years. Move it into assets that no central banker can print and no government can hack. This is not about fear. It is about confidence. When you hold gold, you sleep better at night. You know that no matter what crazy scheme they cook up in Washington, no matter how much money they print, your wealth is preserved. Your labor is stored in an element that is indestructible. The gold rush hour has begun. The clock is ticking. The heavy doors of the vault are slowly closing. Make sure you are on the inside with your metal, not on the outside with your paper. The reset is coming. In fact, looking at the charts this week, the reset is already here. Prepare accordingly, stay skeptical, stay sovereign, and keep stacking.